Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to part 9 of what is now going to be my 10-part video series on Roth IRA conversions. In this video, we're going to kick off our 2025 tax planning, and what an interesting year it is going to be. Right now, we have major tax legislation working its way through Congress, and we will be incorporating all of the final law changes into the personal tax planning template, into our estimated tax payment calculations, and into our Roth IRA conversion strategies. With that in mind, there is no better time to get started with 2025 tax planning than right now. So many people out there are inevitably going to wait until the last minute to start their planning, and then they will be scrambling to figure out how and to what extent all of the new tax provisions apply to their situations and strategies. And scrambling to complete your tax planning before the year-end deadline is a sure way to, number 1, cut corners on your planning, number 2, perform incomplete analysis, and number 3, potentially miss thousands of dollars in tax savings opportunities that once the 12/31 deadline hits, will be gone forever. But we're not going to do that. On this channel with me and Number Crunch Nerds, we are getting our 2025 tax planning started early. And I mean started right now. We're going to get the old mental gears grinding. We're going to get your mind refreshed. We're going to get your initial 2025 tax strategies laid out. We're going to make sure your estimated taxes are paid and you're resting easy on the safe harbor. And of course, we are going to incorporate all of the new and revised tax provisions into our planning strategies once they are signed into law. Thousands of folks in the personal tax planning template program have already figured out their plan to save their family's pocketbook thousands, even tens of thousands of dollars or more over the course of their lives by simply taking advantage of the opportunities that the government is already offering you. Think about it. The government says to you, every year we're going to provide you with a set of tax brackets, and you are allowed to get a certain amount of income taxed in each one. But the Miller family that we have right down here doesn't understand that. The Miller family is under the misconception that tax deferral just for the sake of tax deferral somehow puts them in a better after-tax financial position. So Mr. and Mrs. Miller retired in late 2024. They have some golf and some vacations on the agenda, and they're sitting on a traditional IRA with a year-end 2024 fair market value of $1.5 million. Their W-2 wages have stopped, but their pensions, Social Security, and RMDs haven't started yet. So their income is expected to be relatively low for the next few years. In other words, relatively low compared to what it was, number 1, pre-retirement, and number 2, what it will become once retirement income starts to kick in. So the Millers take a look at their tax brackets for 2025, and what they see makes them happy as clams. Look at that over in the chart on the right. Their income is really low during this time period when, number 1, as we said, W-2 income has stopped, and number 2, retirement income such as Social Security, pensions, and RMDs haven't started yet. In fact, they're only in the 12% marginal tax bracket. If you look over here, this is the Miller Miller family 2025 tax brackets and tax calculation, you can see that the 10% bracket is maxed out up to $23,850 right here, and they have income in the 12% bracket of $32,884. In other words, 12% is the highest rate at which their income is being taxed in this particular year. And let's just assume for this example that this situation continues for 4 years post-retirement. In other words, retirement income like Social Security, pensions, and eventually RMDs don't start to ramp up until 5 years out, which, by the way, is relatively common since folks are generally aware that the longer you wait to start Social Security and often pensions, the larger the payments you can generally expect to receive into perpetuity. So the Miller family grabs their clubs and they head out for some well-deserved fun in the sun. Okay, now let's fast forward 5 to 10 years from now. The Miller family's retirement income has started to kick in. They're collecting Social Security, they're collecting pensions, and they've even started dealing with RMDs. So when we take a look at their future brackets, the Millers find that their retirement income along with their RMDs is causing them to be bumped up into the higher tax brackets. In other words, if we look here at the Miller family's 2035 tax brackets and tax calculation, you can see that they're maxing out the 10%, the 12%, and the 22% bracket right here, and they even have income bumping up here into the 24% bracket. I want to note here real quick that for simplicity, we are holding the tax brackets constant with 2025 for this video example. Within the personal tax planning template program, we do deal with projecting inflation-adjusted tax brackets into future years for our planning purposes. So coming back to the example over here, we can see that in fact the couple has over $40,000 being taxed in the 24% tax bracket in this example. And one more time, you can see that right here with this $45,000 of income being in the 24% bracket. Now, to say that another way, basically taxable distributions of at least $40,000 from the family's traditional IRA, which are being forced on them through RMDs. Remember that RMDs are forced income, the timing of which you cannot control. So that $40,000 plus is being forced on them, and it is being hit with their marginal tax rate of 24%. Now, for simplicity, let's just consider 4 years of this RMD bump up situation. And the question is, how much of the family's hard-earned IRA money are they being forced to hand over to the government during the 4-year period that we're looking at? Well, we can figure that out right here in this little chart. Miller family 4-year RMD taxation. We have the annual RMD of $40,000. We have the years included in this example of 4 years. That leads to total taxable RMD income for this period of $160,000. We know that the family is going to be at the 24% marginal rate during this period, which leads to tax specific to this RMD income of $38,400. Now, before we can say whether this $38,400 is a good or bad outcome for the Miller family, we need something to compare it to. So here's the Johnson family. Now, the Johnson family is in an identical situation to the Miller family. In other words, the Johnsons have also both retired in 2024. Their W-2 wages have stopped. Retirement income hasn't started yet. They also want to partake in some golf and vacationing. And they also are sitting on a traditional IRA with a 12/31/2024 fair market value of $1.5 million. This is exactly the same situation as the Miller family. But there's one thing different about the Johnson family. They have educated themselves enough to realize that tax deferral, just for the sake of tax deferral, may not always put them in a better after-tax financial position. So the Johnson family takes a look at their 2025 tax brackets, and at first glance, everything looks identical to the Miller family. In the Johnson family 2025 tax brackets and tax calculation, they are also maxing out the 10% bracket. They also have $32,884 of income in the 12% bracket, but the Johnsons want to take the analysis a step further. The Johnsons ask themselves, how much room do we have in this tax bracket? In other words, how much room is left inside of this 12% tax bracket right here? Because they say the government has given us the benefit of this tax bracket. The government has basically said, hey, you can have up to $73,100 of income taxed at 12%. By the way, if you look up here, the $73,100 is the difference between the top of the 12% bracket and the top of the 10% bracket. We will do more on that calculation in just a moment. But back to the Johnson family here, they're aware they can have up to $73,100 of income taxed at the 12% rate, but they also know that if you choose not to use it, then you lose it, and you lose it permanently. So how do you figure out how much room is available in the bracket? Well, the calculation is very simple. So right here in the room in the bracket calculation, we're going to start with the top of the relevant bracket. In this case, that's the top of the 12% bracket. That's $96,950, which you can see right over here in the Johnson family tax brackets. Then we're going to take the top of the previous bracket, which in this case is the 10% bracket. The top of that bracket is $23,850, which again you can see right over here in the Johnson family brackets. So the grand total amount of room that is available in the bracket is going to be the $73,100 that I just mentioned a few moments ago. However, we have to go one step further and look at how much income is actually in the bracket already. And in this case, you can see over here in the Johnson calculation that we have $32,884. So we're going to take the $32,884 and subtract it from the grand total amount of room that could be available, and the result will be the amount of room remaining in the tax bracket, which in this case is $40,216. So the Johnsons have determined that they have room of about $40,000 in their 12% marginal tax bracket. And similar to the Miller family, the Johnsons are expecting 4 years of time where they will be pushing out the start of their Social Security and pensions, and RMD income will also not have started yet. So the Johnson family puts all of this information together and they say, hey, what if we just accelerate the distribution of some money from our traditional IRA into years when we have room in our lower tax brackets? Again, the government gave us the benefit of those lower tax brackets, and if we don't use it, then we lose it. So the Johnson family decides, you know what, we're going to do a $40,000 Roth IRA conversion in each year for the next 4 years. In other words, the Johnson family is going to shift income through the use of a Roth IRA conversion from high tax bracket years into low tax bracket years. By doing that, they will take 4 years of $40,000 IRA distributions and use them to fill up their 12% bracket. Basically, they're using up the bracket so that they don't lose it. Now let's check out the results for the Johnson family versus the Miller family. So over here, as you recall, in the Miller family 4-year RMD taxation calculation, they didn't do any Roth IRA conversions. They deferred taxes just for the sake of deferral and let all of the money come out of their traditional IRA in the RMD years. For the 4 years in question that we are looking at, they had an annual RMD of $40,000 times 4 years. That was the $160,000. They were in the 24% marginal tax bracket. So on that specific $160,000 of money that came out of their traditional IRA, they handed over to the government $38,400 in the form of tax. On the other hand, right here with the Johnson family 4-year conversion taxation calculation, here the family has chosen to accelerate income through a $40,000 annual conversion instead of just letting the money sit in the traditional IRA until RMD years. So they have $40,000 per year. We're looking at 4 years in this calculation, similar to the Miller family. So that leads to a total taxable conversion over the 4-year period of $160,000. Now in this case, their marginal tax rate is 12% because they specifically looked at their brackets and they figured out that they had room of about $40,000 in that 12% bracket. And so by filling up that bracket to take advantage of the 12% rate so that they don't lose the ability to do that, they were able to get their tax specific to this Roth IRA conversion income. In other words, specific to this exact same $160,000 of money that is coming out of their traditional IRA, they were able to get that taxed at half the rate and pay $19,200 in tax to the government, as opposed to the Miller family, which paid $38,400 on the same $160,000 of money. So just to summarize that down here with the Johnson family tax savings, the Miller family paid tax on $160K of the $38,400. The Johnson family had the exact same $160,000 in question coming out of the traditional IRA. They just chose to shift the timing of the income to take advantage of the 12% bracket, which was not full prior to doing the Roth conversion. So they paid tax of $19,200, leading to a Johnson Roth conversion tax savings of $19,200 relative to the Miller family. So that's $20,000 in permanent tax savings. In other words, $20,000 of your family's hard-earned money that you kept out of the hands of the government and in your own pocketbook simply by taking a few hours to number 1, lay out your numbers, number 2, find room in your brackets, and number 3, take advantage of the lower tax rates that the government is offering you by using them instead of losing them. Okay, now wait just a second here. Mr. Miller, he's a little bit upset. In fact, he comes racing in from the golf course. He even puts on a tie and breaks out his calculator. There's no way, he says, that the Johnson family got ahead of me by $20,000 in tax savings on an identical financial situation. I thought tax deferral just for the sake of tax deferral was how you got ahead on an after-tax basis. The Johnson family must be missing something here. There's no way they could get ahead of me, Mr. Miller. So he he says, listen up, Johnson family, I'm going to prove it to you. I see your $20,000 in tax savings from your Roth IRA conversion strategy, but I'm going to prove to you that if you don't do that, in fact, if you instead leave the money in the traditional IRA for longer, like we, the Miller family, are doing, thus allowing the money to grow on a pre-tax basis for longer, then that is how you get ahead on an after-tax basis. You've got a lesson coming, Johnson family. And to that, Mr. Johnson replies, challenge accepted, Miller family. But here's the thing though, with your little fancy tie and calculator, I don't want to just hear the words, okay? Show me the numbers. And that's what we're going to do right now. We're going to lay out the numbers and see if tax deferral, just for the sake of tax deferral, is how you get ahead on an after-tax basis, just like Mr. Miller believes. So let's jump in. And by the way, if you enjoy this video, please like and subscribe and let me know in the comments what questions you have regarding Roth IRA conversion strategies, estimated tax payments, and overall personal tax planning for 2025. All right, so let's hop into Mr. Miller's calculations to prove to the Johnson family that he's right. In other words, does tax deferral, just for the sake of tax deferral, put you ahead financially? So as you recall from the previous page, here is the Miller family traditional IRA fair market value at the end of December 31st, 2024. They have a value of $1,548,265. And that's the number we're going to use to start the calculation. So I'm going to bring that same fair market value number right here. There's the 1.5 million. And then what we're going to do is we're going to grow this number. We're going to use a modest 3% annual rate of return right here. And we're going to grow the number out for 10 years. In other words, instead of considering accelerating the taxation of some of this money into earlier years to fill up the lower brackets, Mr. Miller is simply going to defer taxation. He's just going to let this money sit in the traditional IRA, earning at a 3% rate of return, and he's going to do that for 10 years, and then we're going to take a look at the results. So again, this is the starting value right here, and then I'm going to grow it by 3%. If I double click on this cell, you can see it's this amount multiplied by 1.03, so that grows this number at 3% for 1 year. And then if I double click on the number right below it, you can see it takes the value at the end of the first year of growth and it multiplies that by 1.03, so that increases the value by 3% again. And that process will continue for each year until we get down here to the 10th year. You can see that's just the previous year again multiplied by 1.03. And so this number right here, this is the fair market value at the end of 10 years of growth, $2,080,739. And this is the pre-tax traditional IRA value that Mr. Miller has accumulated by just leaving the money in here, not doing any Roth IRA conversions, deferring tax just for the sake of deferring tax and allowing the money to grow at 3%. All right, I want to be very clear on this next point that I'm going to make right here, because I know if I'm not clear on this point, I'm going to get at least one person in the comments saying, yeah, bro, but like if they try to take out the $2 million all in 1 year, it's not going to be like taxed at 24%, bro. It's going to be like taxed at 37%, the highest marginal rate. Okay, thank you. Thank you for pointing that out. Let's be very, very clear what I am saying right here. This calculation that we're about to go through on these next couple of lines, this is not suggesting that Mr. Miller is going to try to take out this full traditional IRA value in 1 year. That is not what we're doing right here. What we are saying is that after the 10 years of growth, Mr. Miller will be in RMD territory. inventory, and over time, whether that's 10 years, 20 years, 30 years, whatever the length of his RMD period is until his ultimate passing, he will continue to be in the 24% marginal tax rate. In fact, both families are going to be in the 24% tax rate into perpetuity in their RMD years. We will see that coming up with the Johnson family in just a few minutes. So what we're saying here is that the value of this IRA right here, this $2 million, this will be distributed from the IRA in the form of RMDs over time. And thus all of this income will be taxed in the 24% marginal bracket over time. So instead of laying out like 30 columns for 30 years and having a certain amount of RMD in each one and each RMD being taxed at 24%, we're simply collapsing all of that into one column and saying that over time, all the money in this traditional IRA will be distributed during RMD years and will be taxed at 24%. And so with that in mind, then the tax specific to all of the RMDs, in this case, if I double click on this cell, will simply be this total traditional IRA value at the end of the 10-year growth period multiplied by the marginal rate, resulting in tax of $499,377. And thus the value of the after-tax cash that Mr. Miller can take out of his traditional IRA over time in this scenario, if I double click on this cell right here, it's simply the $2 million starting value less the $499 of tax, resulting in $1,581,361. Okay, so now that we have the basics of Mr. Miller's situation laid out, we need to move over here to the Johnson family calculation. Now, as you recall, the Johnson family fair market value of their traditional IRA at the starting year is going to be identical to the Miller family. So we have the same $1,548,265 that we have right here. They're both starting in exactly the same situation. And the first part of the calculation here is going to be very similar to what we just saw. Here is the same number, starting point right there. We're going to go down to the next year and we're going to grow the value by 3%. But then something different is going to happen. At the end of the first year, the Johnson family, as you recall, has decided to do a Roth IRA conversion. And the amount in each of the 4 years is going to be $40,000 as we previously discussed. So what we're going to do right here is take this value, which is the ending value after 1 year of growth at 3%. Then we're going to subtract off the $40,000 conversion because that's $40,000 of cash coming out of the traditional IRA. And then in this column right here, we're going to have the balance after conversion. So if I double click on this cell, you can see it's simply this balance after the 3% growth less the $40,000 of conversion, which brings us from $1.59 million down to $1.55 million. So this number right here is the final ending balance at the end of year one, after 3% growth and then after $40,000 in cash comes out of the traditional IRA. Now this number right over here, this balance for year two, this is going to be the final ending balance from year one over here multiplied by the 3% growth rate. That's what this number is going to be. Then we're going to subtract off another $40,000 for the conversion, getting us to $1.56 million. Then right here in this cell, we're going to grow that number by 3%. Then we're going to subtract off another $40,000 and the process will continue. Grow by 3%, subtract off $40,000. And then once we get to this ending balance here, the next year's balance will continue to grow at 3% off of this number, but then we're no longer going to have any more Roth conversions. As we discussed, it was just going to be the 4 years, so each of these will simply grow at 3% off the ending value from the previous year. And ultimately, when we we get down here to the end of the 10th year, the fair market value of the Johnson family traditional IRA is going to be $1,889,020. Okay, now again, similar to the Miller family, we're not saying we're distributing the entire balance in 1 year. We're simply saying that the Johnson family, just like the Miller family, will be in the 24% marginal bracket for the entirety of their RMD years, and thus this balance of $1.8 million will be distributed over time in the form of RMDs, and all of it will be taxed at 24%. And so the total tax on their RMDs right here is going to be $451,421. And then when we get down here to the fair market value of their after-tax cash coming out of the traditional IRA, it's going to be this $1.8 million less the $451,000 of tax, which you can see right here. If I double click on that cell, it's this number less this number here. So the Johnson family has after-tax cash value of $1,429,499. Okay, but wait a minute. There's more to this calculation, isn't there? Because what happened to this money that came out of the traditional IRA and went into the Roth IRA? Okay, great question. Let's keep moving on with the calculation. So the first thing that happens is we're going to assume that a portion of the money that's coming out of the traditional IRA is going to be used to cover the tax on the conversion. In other words, the tax in this example is not being covered by outside funds. I don't want to introduce any outside funds to this comparison example. We're simply going to take part of this money and use it to pay the tax, and whatever is left will ultimately go into the Roth IRA. So that calculation is going to occur right here in this column. If I double click on one of these cells, you can see we're taking the $40,000 conversion that's coming out of the traditional IRA, and we're multiplying it by the 12% tax, which will be due. That's the 12% marginal rate we're using in this calculation. So the result right here would be $4,800, and then in the next column, cash that goes into the Roth, we're going to double click on this cell, and you can see we're simply taking the total amount of the conversion, we're subtracting off the $4,800 in tax, and that leaves us with $35,200 that will actually go into the Roth IRA. Okay, now scrolling over here to the last part of this calculation, here's the Johnson family Roth IRA calculation. We're going to assume for simplicity that the starting value of the Roth IRA is 0. So the only thing in the Roth will be the amounts that were converted from the traditional into the Roth. So the way I have this set up right here is this is going to be the starting value of 0 right here. There is no return in the first year because there's no starting balance. Then we're going to add the conversion of $35,200 right over here, resulting in an ending balance for the first year of $35,200. Okay, then what we're going to do is we're simply going to carry this ending balance over here to the beginning of the year. Then we're going to calculate our rate of return. If I double click on this cell, you can see this is simply the $35,200 grown at 3%. This is just the growth itself, not the total balance. In other words, 3% of $35,200 results in a return of $1,056 for the year. Then we're going to add in another $35,200, which is the conversion that occurred at the end of year 2. And then right here in this ending balance cell, we're going to add up the starting balance plus the return plus the amount of conversion that went into the Roth, and the result at the end of year 2 will be $71,456. Again, one more time, that will carry to here. This will be 3% return on the beginning balance. We're going to add in another $35,200 of conversion, and the result right here, if I double click on that, will be the sum of these three, and we have $108,800 as the balance at the end of year 3. That will continue for the 4th year of the conversion, and then for all of the remaining years right here, we're simply going to increase the initial value by 3%, and then this cell will simply add the starting balance to the amount of return. There won't be any additional Roth conversion, and that will be the ending balance. And ultimately, at the end of the 10th year, under this fact pattern, the ending balance in the Johnson family Roth IRA is going to be $175,841. Now, one thing to note before we move on from this section, we are using the same 3% rate of return in the Roth IRA as in the traditional IRA. We are also using the same 3% rate of return between the Miller family and the Johnson family. The rate of return on the underlying investments is not a factor we need to consider. We have set that equal between the two families. We have set that equal between the two different account types. You can invest in the same stocks, bonds, mutual funds in a traditional IRA as you can invest in a Roth IRA. So there's no difference in the rate of return. What we are looking at are the tax implications of these two accounts. The rate of return is set equal across all scenarios here. Okay, so now we have $175,841 of after-tax value in the Roth IRA. Remember, this is all after tax now. This will no longer be subject to any tax. So we're going to take that $175,841 and we're going to scroll back over to the left earlier in the calculation right here, and I'm going to scroll down a little bit, and I'm going to add that $175,841 right here, the fair market value of the after-tax cash in the Roth. And so then the final step right here in this part of the calculation is we're going to take the after-tax cash value from the traditional for the Johnson family, which was $1.4 million. We're going to add to that the after-tax cash value in the Roth, which was $175,000. And the result is that the fair market value of the total after-tax cash that the Johnson family has between both of their accounts is going to be $1,605,340. Okay, wait a minute. Hold on a second. Now, the Miller family only has $1,581,000 right here after their 10 years of deferring tax. But the Johnson family has more. They have $1,605,340 after performing their 4 years of Roth IRA conversions. All right, so let's go down here to this results analysis and summarize everything that's happened so far. So right here we have the Johnson family total after-tax cash fair market value of $1,605,340, and that's the number that came from right up here. Then on the second line we have the Miller family total after-tax cash fair market value of $1,581,361, and that is the number that came from right over here. So you can see that the Johnson family is ahead of the Miller family. They have excess after-tax cash from their combined Roth and traditional retirement accounts of $23,978. Now wait a second, Mr. Miller is getting grumpy over here. This is more than just the tax savings that the Johnson family identified earlier. Remember, the tax savings from those Roth IRA conversions was $19,200. If we go back real quick to our conversation over here on the first tab, there's the $19,200 that we had identified earlier. And actually, we can confirm that on this page as well. Let me just scroll over to the right here just a little bit to the start of this final section that we're going to do. If I look at this, this is the 12% tax savings from conversion. If I click on one of these cells, what is this calculation right here? Well, it's cell J31. Let's scroll up real quick and see what that is that is the amount of the conversion, the $40,000. And then if I go back down here, this is I-23 minus M8. So I-23 is right there. That's the 24% original tax rate that they would be subject to in their RMD years. M8 right here, if I scroll up to the top, that is the 12% tax that they are currently paying. So basically going back down to here, this is 24% minus 12%, which happens to be 12%. So the tax savings is the $40,000 conversion multiplied by the difference between the two tax rates, in this case 24% minus 12%. That's where the $4,800 annual tax savings comes from, and you will find that if you take $4,800 times 4, it equals $19,200 in tax savings. But there's more here. There's more savings than just the $19,200. Mr. Miller is confused. How did the Johnson family get ahead by $23,978? That is almost another $5,000 ahead, in addition to the $19,200 of tax savings. Okay, what is this? What is this additional $5,000 in after-tax cash that the Johnson family has? Well, we're going to prove that out right now. Let's scroll back over here to the right to this final part of the calculation. And what we're going to find right here in what I've called the Johnson family excess after-tax cash analysis is something that few people truly understand. Let's just say what it is in words first, and then we will crunch through these numbers right here. I want you to think about what happened right here very carefully. In the Johnson family calculation, we did these Roth IRA conversions, and what happened is that basically we paid half the tax. In this example, the tax is 12% versus 24, so that's half. We paid half the amount of tax on this cash. So to flip that around and look at it the other way, the other half that we saved ended up in the Roth IRA right here. Let me say that again. If we think back over to the left to the Miller calculation where this did not occur, we did not do any conversion. All of this money just sat in the traditional IRA until we got to the final year. And then over time in RMD years, this $160,000 was all taxed at 24%. But in the Johnson family calculation, we got this $160,000 out of the traditional and taxed at just 12%, which means the remaining 12% of tax savings ended up here in the Roth and is now compounding on an after-tax basis. Instead of what would have been the savings sitting in here compounding on a pre-tax basis but then being subject to 24% tax, that savings over here ends up in the Roth and grows over time. So the Johnson family is not only getting the initial $19,200 of tax savings, they are gaining additional return on the tax savings itself because the savings is effectively sitting in the Roth. Now, going back down here to this excess after-tax cash analysis, let's prove that out in numbers, not just in words. In numbers, let's show that that is true. We're going to do this calculation just like we did the Roth IRA calculation above, but we're just going to do it with the tax savings itself. So here's year one. The beginning balance is 0 because the conversion didn't happen until the end of the year. Therefore, there's no return on any savings because there is no balance to start. Then we bring the tax savings into the Roth IRA. The tax savings is part of the $35,200, which is up here. It's not in addition to it. It's just included in this. We are simply isolating this for illustrative purposes so that you can see where that extra approximately $5,000 comes from. So part of that $35,200 is actually this $4,800 in tax savings. So the ending balance equals the amount of the conversion. That carries forward to the beginning beginning of the next year. Then right here in this cell, if I double click on that, we're simply calculating the 3% rate of return on the tax savings only, just for purposes of this calculation. Then we add the additional $4,800 of tax savings that is part of the conversion in year 2. We calculated that before right over here. And then the grand total, just as before, is the sum of the beginning balance plus the 3% return plus the additional tax savings that's part of the conversion, resulting in this ending balance right here. And the process will continue just as we went through above with the total amount inside the Roth. This is just the same calculation with the tax savings in isolation. You can see the same thing once we get down to year 5. This right here is simply 3% return on there, but since there is no more Roth conversion happening, then there's no more tax savings component of the conversion. So this number is going to be 0 when we sum this up, and then the process will just continue with the 3% rate of return, no additional amounts added, until we get all the way down here to $23,978. And this $23,978, that is the same $23,978 that we calculated right over here. And right here in these two columns, you can see the components breakout of what that $23,978 consists of. It consists of 1, the tax savings itself, which we already knew about, and it also consists of number 2, the rate of return on that tax savings, because that tax savings is now sitting in the Roth IRA compounding on an after-tax basis. And so if we go down here to the final results, you can see that now Mr. Miller is really sad. He's down $20K in taxes alone, and he's down another $5K in investment return on that tax savings. And do you know why poor Mr. Miller is in this situation? It's all because he thought that tax deferral just for the sake of tax deferral actually mattered. On the other hand, Mr. Johnson over here, well, he's living the high life. He's up $19,200 on his Roth IRA conversion strategy, and he's up another $5,000 on investment return on the tax savings itself, because he educated himself enough to realize that tax deferral just for the sake of tax deferral does not necessarily get you ahead on an after-tax basis. I've said it before on the channel, and I will say it again. There is no difference between a traditional IRA and a Roth IRA if your tax rate never changes. Let's prove that out right now. Let's scroll back up to the top of this calculation. Let's go back over here. Let's look again at the difference between the Johnson family's results at $1,605,340 and the Miller family's results at $1,581,361. The only reason that there is a difference here is because the Johnson family's tax rate did not stay the same over the course of their life. It did not stay the same because they accelerated income into a lower bracket, into the 12% bracket, and got it out of the 24% bracket. Let's prove it out right now. What is going to happen if I change this number right here to 24%? In other words, the tax on this conversion and the tax that would be applicable in their RMD years was the same. In other words, I changed this so that there was no difference in their tax rate over the course of their life. What is your expectation? What is going to happen to this number right here if I change that to 24%? I sure hope that if you've been paying attention and you've been listening to me, your expectation would be that this number right here is going to become equal to this number right here. It will be the exact same number down to the dollar. Let's test that out. I'm going to go right here to this cell. I'm going to double click on this number. I'm going to type in 0.24 for 24%. I'm going to hit enter. And what just happened? this number right here through the combination of the traditional IRA value plus the Roth IRA value became equal to $1,581,361, which is exactly the same value as the Miller family has over here. There is no difference between a traditional IRA and a Roth IRA if your tax rate never changes. These vehicles are tax rate plays. You have to understand that your tax rate will change over the course of your life, and if you can use these two different vehicles, the traditional IRA and the Roth IRA, appropriately in combination, you have the potential to save tens of thousands of dollars over the course of your life, as we have just demonstrated. But I know that the light bulbs are going off right now even more than before, because I know that previously you were probably just thinking that the tax savings itself was the only benefit to doing those Roth IRA conversions, but it's not. It's the tax savings itself plus the rate of return on those savings compounding after tax over time. In the personal tax planning template program, I lay out a complete roadmap for you to lay out your numbers, find room in your brackets, and figure out where you can save tens of thousands of dollars in taxes and gain the rate of return on that savings with simple, easy to follow video explanations. Imagine just handing over tens of thousands of dollars of your family's hard-earned money to the government because you won't take a few hours to sit down and figure out how to avoid it. For less than the price of one night's dinner out on the town, you can get lifetime access to me and all of the resources that I provide within the course, so you can figure out how to keep tens of thousands of dollars out of the hands of the government and in your family's pocketbook. As I've said before, as an American, you have every right to pay too much in taxes. And the IRS will never show up at your door, not today, not tomorrow, not ever, and tell you, hey, you know what you could have done? You could have actually utilized those brackets that we gave you by shifting income into your low bracket years by simply sitting down, laying out your numbers, and doing some tax planning. But you have to want to do it. If you don't want to do any tax planning, that's your choice. Nobody will force you to. Not a soul on earth will ever show up and force you to do any tax or financial planning. So with that said, if you're interested in the personal tax planning template program that you have seen me demonstrate throughout this video series, you can find a link to purchase that program in the description below this video. And yes, because I know at least one person is going to ask, this optimization calculator that you've seen me using right here on this screen is available for download as part of the program, as are all of the calculators, resources, and spreadsheets that you have seen me demonstrate in previous videos within this series. Alright, so now that we realize that tax deferral just for the sake of tax deferral is not how you are going to get ahead financially, and what we really need to do is optimize the utilization of your tax brackets and get as much money as we can taxed at the lowest rates possible, let's kick off our 2025 tax planning by doing a refresher of our Roth IRA Conversion Timeline. Alright, so we're in the timeline starting over here on the left-hand side at 59.5 years old. What was the significance of this age right here? And it's that this is the age where you can start to take distributions from your traditional IRA without incurring any penalty on those distributions. And so what that means in practice is that you can use funds coming out of the traditional IRA to cover the tax on the conversion, just like we saw in the previous example with the Johnson family. If you recall right here in this section, putting the tax rate back to 12% for the original example, we said that of the $40,000 of money coming out of the traditional IRA, $4,800 of it went to actually cover the tax, and then the remainder $35,200 is what ended up going into the Roth. Now, of course, pre-59.5 Roth conversions are possible, but you have to pay the tax on the conversion using outside funds in order to avoid the 10% penalty. In other words, all of the money that comes out of the traditional IRA, like the $40,000 in the Johnson family example, all of it has to go into the Roth IRA. You can't use some of it to pay the taxes, because the portion of it that goes to pay the taxes is the portion that will be penalized with the 10%. So again, you can do Roth conversions over here, but you have to use outside funds to cover the tax and not use funds to cover the tax that are actually coming out of the traditional IRA. So for that reason, we start the Roth IRA conversion sweet spot right here at 59.5. Now, before we cover everything in the middle here, let's just go over to the other end of the timeline at 73 years old. What is the significance of age 73? Well, as you know, 73 is the age at which RMDs are required to begin. Note that the age will change starting in 2033 up to age 75. And this will be important for your planning purposes, provided that you do not reach age 73 by this date right here. Then within the personal tax planning template, you will start your projections of RMDs at age 75. But for the moment, for purposes of this discussion of the timeline, let's just stick with 73 years old as the age when RMDs start. So once we cross this line, we are now in RMD territory for the remainder of our lives, or of course until the IRA is depleted, whichever one comes first. But with that said, you will see within the RMD calculations that we get into within the personal tax planning template program that it's designed not really to ever totally deplete the account. Unless you intentionally take out more than the RMDs, the traditional IRA account will never fully deplete before your passing, and there will be some balance left to pass to your beneficiaries. One other thing to note over here on this side of age 73 is the RBD. This stands for your required beginning date, and this is only an applicable thing in the first year that you are taking RMDs. What this means right here is that once you turn 73, you are required to start taking your RMDs by April 1st of the year after you turn 73. We're going to be doing a lot of discussion this year on the channel about both spousal and non-spousal beneficiaries. And when it comes to how your beneficiaries, whether it's your spouse or otherwise, have to deal with an inherited IRA and the RMDs that are associated with it, this RBD date is going to become relevant to that discussion. So now is a good time for us to make sure we understand what it is. You will be seeing this RBD coming up again and again on the channel in future videos. So going back to age 73, the reason that the Roth IRA conversion sweet spot is going to stop right here is because once you get into RMD territory, once you get beyond the age of 73, you are required to take your RMDs prior to doing any Roth IRA conversion. In fact, starting in 2025, you are required to take your RMD from all of your traditional IRAs. So in other words, like if you had 3 traditional IRAs, there's going to be an RMD associated with each one. You have to take the RMD from all 3 before you can do any Roth conversion from any particular one. Said another way, you are no longer allowed to, for example, just take the RMD from like traditional IRA number 1 and then perform Roth conversions out of traditional IRA number 1 prior to taking your RMD from traditional IRA number 2 and 3, for example. You have to now take your RMDs from all accounts before doing any Roth conversion. But even more important than the mechanics of all of that is the fact that now you're going to have a whole bunch of RMD income already, and then if you do Roth conversions, you're going to have a whole bunch of income from that. And so by the time you add up all of those things, the benefit of doing a Roth conversion could be minimized. Again, as with everything in our tax planning, it's all going to be based on your personal facts and circumstances, and therefore you're going to have to lay out your numbers out here in these years to figure out if any Roth IRA conversion is still beneficial. But just generally speaking, because of the RMD income, Roth conversions will probably be less beneficial once you get into RMD territory over here, and that's why we're going to cut off the definition of the Roth conversion sweet spot at 73. All right, now coming back over here to this side of the chart, let's look at 62. What is the relevance of that age? And it is the age when you can first choose to start taking Social Security. You have the choice of starting anywhere between age 62 all the way out to age 70. Now, when it comes to the Social Security start date decision, there are many factors that you have to consider. One of the main ones could potentially be your income needs between the ages of 62 and 70. This video is not about all of the considerations that you're going to have to go through to make this choice. The only one that I really want to focus on for this video is the impact on the Roth IRA conversion decision. And the thought process will go something like this. The sooner you start collecting Social Security, the more income you will have in these years right here, which means the more filled up your tax brackets will be already. And therefore, if you think back to the discussion at the beginning of this video, if the brackets are already more filled up with Social Security income, then there would be less room for Roth IRA conversion income, just generally speaking, right? So from that perspective, if you think about the Social Security start date decision, the further you can push out the start date, like if you can push it out to here, for example, then you have created all that much more room within the tax brackets in the earlier years. Again, that certainly is not the only consideration when deciding on the age for which you want to start collecting Social Security, but it is something I just wanted to point out since we are talking primarily about doing Roth IRA conversions. That is a consideration that you should be aware of. Okay, now going back over here, I have defined the Roth IRA conversion super sweet spot to be between the ages of 59 and a half and going out to about age 63. Now, what is the relevance of age 63? Well, if we look right over here, we can see that 63 years old is about the age when IRMAA measurement is going to start to become relevant. IRMAA, as you know, is a surcharge on your Part B and Part D Medicare premiums. And the amount of surcharge that you're going to be subject to will depend on your income, and specifically it will depend on your income from 2 years prior to the current year. So for example, Medicare starts at age 65. So let's just say that 65 is right around here somewhere. So your surcharge for Medicare for the year when you are 65 is going to be based on your income from 2 years prior when you are 63. So with that in mind, what do we have to consider about this just in general? Well, if we are bringing Roth IRA conversion income back here into these years, then the amount of income that we have is going to increase. And if the amount of income that we have increases, it does have the potential to impact our IRMAA surcharge. Now, just as a reminder, we're not going to go over the details of this in this video. You can go back to Roth IRA Conversion video number 3 in this series if you want to learn about the IRMAA brackets, which are cliff brackets, which means once you're in by $1, you're in all the way. They're not marginal brackets, which are the income tax brackets, are marginal brackets. If what I just said, you are like, I have no idea what you're talking about, Roth IRA Conversion video number 3 in this series is where you want to go. And so just to summarize that, because IRMAA becomes a consideration starting right around the age of 63, but is not a consideration prior to that age, I am going to define the super sweet spot for Roth IRA conversions to be within this area right here. All right, so that covers the overall Roth IRA conversion timeline that we're going to be working with. Next, let's take a look at the RMD timeline. All right, so here we are on the RMD timeline, and it's going to work something like this. RMDs will start at age 73, as we talked about on the previous screen. There's your RBD, which is April 1st of the year following the year when you turn age 73. And your RMD territory, generally speaking, is going to go out to the year when spouse number 2 passes. Now, there are a number of different options in here for surviving spouse, and I want to talk about that extensively. I'm going to have at least one video exclusively on talking about this situation, because the person who has the most options when it comes to what to do with an IRA that is coming from a spouse is going to be the surviving spouse. They have the most options relative to, for example, your kids over here, which are called non-eligible designated beneficiaries. We'll get into all those definitions later. But basically, this is your kids out here, which is going to be your most common beneficiary other than your surviving spouse. Your kids have, generally speaking, fewer options with what to do with an inherited IRA as compared to the surviving spouse who has more options. For now, we're going to leave discussion of what all the choices are within this section right here for another video. What we're going to consider for this video is just generally speaking that spouse number 2 will continue to take RMDs in some form or another until they pass, and then ultimately the IRA will go to a non-eligible designated beneficiary, which is usually going to be your kids. The one item I want to point out in here, which we have talked about before but which doesn't get a lot of attention, is widow's penalty. Remember that if your spouse inherits your IRA, and let's just say they basically treat your IRA as their own, which is one of the options, they're basically going to be taking roughly the same amount of RMD that the two of you were taking together. In other words, they will be taking RMDs from their own IRA, and they will be taking RMDs from your IRA, which is now basically their IRA. So they're taking the same amount of RMDs. It might be a little different, but just generally speaking, let's say they're taking about the same amount of RMD income every year, but they are in the single tax brackets, which are much lower, right? There's much less room in those single brackets. And so they're working with the same amount of income, but much lower brackets. And so they're going to get dinged with more tax. That phenomenon that I just described, you could say, is called the widow's penalty. And that is another reason why you want to start considering doing Roth IRA conversions to the extent that you can get as much income taxed in those lower brackets as possible, those larger lower brackets that are available to a married filing joint couple. You want to stuff as much income into those brackets as you possibly can, generally speaking, because your surviving spouse is going to get hit with widow's penalty. Obviously, I'm assuming that surviving spouse does not remarry in this example. If surviving spouse does remarry, that opens up a whole different set of issues. For example, protecting the family's assets from the new spouse potentially. That's something you would want to sit down and talk about with an estate planning attorney if that was something you were concerned about. But for purposes of today's discussion, let's just assume that spouse 2 does not remarry. By the way, for those of you that are not aware, the personal tax planning template does have functionality built in to test the tax implications of one spouse ultimately ending up in the single brackets and what it will do to your overall lifetime effective income tax rate. And when you start taking a look at that, you will see that generally speaking, if you have the chance to fill up those lower brackets in earlier years, those married filing joint lower brackets, I should emphasize, it is generally quite beneficial to do so from an overall lifetime effective tax rate perspective. Okay, now let's look at what happens after spouse 2 passes and the remaining IRAs go to your beneficiaries. Well, in the situation that is described right here, your kids are going to be subject to the 10-year rule. And there are some different variations on the 10-year rule, which we will discuss in another video, but the most common situation is that both you and your spouse have passed your RBD. Remember, I said earlier that this date will become relevant when we get to talking about inherited IRAs for your beneficiaries. So assuming that both of you have passed this date right here, then when your kids inherit a traditional IRA, what's going to happen is they are going to be forced to take RMDs, in other words, taxable distributions, in every year of the 10-year period. They are also going to have to deplete the account in its entirety by the 10th year. So think about the tax implications of that for your beneficiaries. If they are high earners, for example, and they start getting hit with all of these RMDs, what bracket do you think this is going to be taxed in? Well, it's going to be whatever their highest marginal rate is. And often, generally speaking, if you are of this age out here, in other words, beyond the age of 73, what generally is going to be like the age of your kids? It's probably going to be the age, let's just say generally speaking, it's going to be the age where they could be in their highest earning years. So they are already in some of the highest brackets that they will be in for their lifetime. And then on top of that, you're going to be dropping in RMD income every year for 10 years, and it could bump them up into tax brackets that they may otherwise never be in, but for the fact that they're getting this RMD income. Also keep in mind that if they just take the actual amount of calculated RMD in the first 9 years, the 10th year over here is going to be a balloon, meaning everything that is left in the account is going to all have to come out in 1 year, and that could potentially bump them up into the highest tax bracket just depending on what the balance is right here. So I would say that the key takeaway from this right here is that if you don't start doing Roth IRA conversions in a strategic manner, of course, taking into consideration all of the factors that we go through in the personal tax planning template program, but if you don't start at least getting some of this income out of the traditional IRA and taxed at the lowest rate possible, it's ultimately going to get taxed over here, and you're going to leave the burden of dealing with that on your kids or whoever your beneficiaries are. Now, alternatively, let's consider what happens if your kids inherit a Roth IRA instead of a traditional IRA. And in basic terms, it's going to work like this. The 10-year rule is still going to apply in the sense that by the 10th year, they have to liquidate the entire account. However, there is going to be no RMD requirement for the first 9 years. And by the way, even if there was, the money comes out of a Roth IRA tax-free anyway, so it wouldn't have a tax implication to them even if there was an RMD required. But let's think beyond just the tax effects. What about the investment effects? Think about it. Down here here, if your kids do not have to take an RMD in any of these years, that means they can leave the money in the Roth IRA untouched to grow tax-free for nearly an entire decade. You will get all of that compounding tax-free growth for an entire decade, or I should say your beneficiaries have the option to do that, and then they can just liquidate the entire account in the 10th year, again with no tax implications since it's coming out of a Roth IRA. Alright, so let's summarize the effects of the 10-year rule on your beneficiaries between the Roth IRA situation versus the traditional IRA situation. And I also want to make a clear distinction between the situation that we are talking about right now versus the comparison that we did earlier between the Johnson family and the Miller family. In the example of the Johnsons versus the Millers, we were talking about taking money from one tax-advantaged account type, in other words, the traditional IRA, and moving it into another tax-advantaged account type, i.e. the Roth IRA. So that example was purely a tax rate play because we were using the two different account types in conjunction with each other in order to take advantage of the lowest tax rates possible. And all of the savings and additional return in question ultimately related back to the tax savings itself plus the growth on that tax savings. But in either case, the money was continuing to grow in one tax-advantaged account type or the other. This situation that we are describing right here is a little bit different. By the time the IRAs reach your ultimate beneficiaries, there is no longer any option to play the two account types against each other. For example, your beneficiaries cannot perform a Roth IRA conversion, for example, and try to get some of the money out of this account type right here and put into this account type right here. That's no longer available. So the distinction that we're talking about here is in this option down here with the Roth IRA, your kids have the ability to keep the money growing in a tax-advantaged account for up to 10 years, whereas with the traditional IRA, the only option is that the money will come out every year and just go into a regular brokerage account, for example. So as this distribution comes out and then this distribution comes out and so forth, these amounts are now going into a non-tax advantaged account. And so when they earn interest and dividends and capital gains, all of that stuff is no longer going to be deferred. It will be taxed on an annual basis. Once we get to that point in the RMD timeline, basically once we get to the end of the RMD timeline, now there is a benefit to keeping the money in a tax-advantaged account for as long as possible so it can compound on a tax-free basis, because we are now comparing a tax-advantaged account to a non-tax-advantaged account where all of these distributions are going to go on an annual basis. So just to summarize the effects here, your beneficiaries will get hit at their highest marginal tax rate in every year for 10 years if they inherit the traditional IRA. In addition, all of the distributed annual amounts will no longer be able to compound tax deferred. They will go into a regular brokerage account that is taxable annually. Alternatively, down here with the Roth IRA, beneficiaries can take distributions anytime with no tax impact, and they also have the ability to let the entire balance just sit there and grow tax-free for 10 years. So if you want to do right by your beneficiaries, if you want to reduce the tax burden on them and allow them the possibility for the most tax-free growth possible, in other words, if you want to consider tax planning from the perspective of the family unit and you want to leave your beneficiaries in the best possible position, then it behooves you to take a look and see how much of that traditional IRA can you get converted into a Roth account and taxed at the lowest possible rates in the process of doing that. And one thing that might be helpful for your thought process is try not to think about this as an all or nothing situation. Meaning, don't think that you need to get all of the traditional IRA converted into a Roth. In fact, that is relatively rare. I have seen it a couple of times, but for the most part, people don't get their entire traditional IRA converted. Just like we saw in the comparison of the Johnsons versus the Millers. The Johnsons didn't get their entire traditional IRA converted. They got some portion of it converted, and they were able to reap the rewards of the tax savings plus the compounding growth on that tax savings on that portion which they were successfully able to convert. And so if you think about it like that, and you think, for every dollar that I can get converted at the lowest rate possible out of the traditional into the Roth, not only will I be reducing the tax burden that ultimately hits my kids in the 10 years after my passing, but I will be leaving them in the best position possible for future monetary growth on the money that they inherited from me. But again, you have to want to do it. You have to want to leave your beneficiaries in the best possible financial position that you can. If you don't want to do it, then that's your choice. If you want to think about tax planning just from your personal perspective and not from the perspective of the family unit, that is your choice. But I can assure you that generational wealth is not created by thinking just about yourself in isolation. It's about considering the family unit as a whole, understanding that the tax law in the United States is most favorable to the family unit more than the individual, and to conduct your tax planning activities accordingly. Alright, so one of the last things I want to do in this video for purposes of our 2025 warm-up is simply to walk through a diagram of the overall Roth conversion strategy. So starting over here on the left, we have our 59.5 years old. There is our Roth conversion sweet spot going out to age 73. There is our RMD territory. And then over here on the left, we're going to be in employment income, generally speaking, and exactly what age this will stop will obviously vary by person, but just in diagram format, it's going to look something like this. And then of course, once you retire, we will be over here on this side of the chart. So looking down here in this section, these gray bars basically represent your level of income. And I haven't put any specific numbers in here. Let's just go with income level being high at this line. Obviously, what constitutes a high income level is going to vary by person. So we're just going to do this graphically without any numbers. And then down here, we're going to have a low income level. Low income level for the year would be associated with a low marginal tax rate. And then a high income level would obviously be associated with a higher marginal tax rate. So the way we have this set up is that in the employment years, I would generally expect to see an increasing level of income as people get closer and closer to retirement. And in the years that are closest to retirement, I would expect most people to be in some of their highest earning years. Highest earning years with respect to employment income anyway. And right down here, this label just sort of indicates what the general expectation of kinds of income or sources of income would be. And of course, we are looking at employment income or business or self-employment income. Usually will be the most common and the largest types of income that people have. Okay, then once we cross the line here into retirement, what you typically see, and this is the exact same thing that we saw in the Johnson family versus the Miller family example, is that people's income will tend to drop off for a number of years right here. They are in the post-retirement years, but they are also in the pre-Social Security, pre-pension, and pre-RMD years. And for a lot of people, just like we saw with the Johnsons and the Millers, there are usually a number of years in here where folks' income drops off really low. And when that income drops off, we tend to have a lot of room in those tax brackets. Then going out here further in retirement, that is when Social Security, pensions, and RMDs will start, and they may not always start at the same time. Often they don't, actually. And so what we will tend to see is income starting to increase over a number of years, and then once you get into full-blown RMD territory, your income is going to be back up in the higher range. Okay, now going over here to Conversion Tax Strategy tab number 2, and so our goal in the Roth IRA Conversion Strategy is to look out here in these high income years. As I said before, we are probably not looking to convert all of the income that is sitting in those traditional IRAs, but we don't need to convert all. What we want to convert are those amounts that are bumping us up into these highest brackets right here. We want to lay out our numbers. We want to figure out how much this is right here. Then we want to backtrack to these years where we're typically in those low brackets, and we want to figure out how much room we have. And then ultimately through Roth IRA conversions, we want to grab as much of this income as we can, and we want to shift it back over here and get it taxed at the lowest rates possible. By doing that, we are also potentially getting this income out of widow's penalty territory. We are also getting it converted over to Roth IRAs so that our beneficiaries, our kids, can inherit the largest amount of what we pass along to them in the form of a Roth IRA and the least amount possible in the form of a traditional IRA. Again, it's not going to be all of the balance. They will most likely inherit both a traditional and a Roth IRA if you're doing a strategy like this. But again, for every dollar that you can get out of here and bring over here, you reduce the tax burden on your beneficiaries, and you also create a situation where they have the most money possible in the Roth IRA and have the potential to leave it there for up to a decade so it can compound tax-free. Okay, now if we do a quick comparison between the personal tax planning template and this diagram down here showing the Roth conversion strategy, what I want to bring your attention to is simply this section right here. This is the ordinary income tax calculation section of the personal tax planning template. I just want you to take a look at this tax calculation high level in comparison to this graphic right here. So as I said before, the general expectation is that during your employment years, we would expect to see income levels rising over time, and that would correspond to your marginal tax rate rising over time. And so if you look right here, these are the tax rates starting at 10% and going all the way down to 37%. So in the earlier years of employment, we're in the lower brackets, just like right here on this graphic. And then as we get out into the later years of employment, we are higher up in the brackets, just like as depicted on this graphic right here. And then when we first retire, suddenly there's a big drop in income and we drop down into some of the lowest brackets. And that's exactly what's being demonstrated right here in this part of the graphic. And then over here, as we get out into retirement and Social Security and pensions and ultimately RMDs start to kick in, we may find ourselves out here in the highest brackets again. And often it's kind of a gradual ramp up from here to higher brackets there, to higher brackets there, to the highest brackets out here. And that's conceptually the same as this ramp up right here into the highest brackets. And so when I said we're looking out here to find that income that's being taxed at the highest rates and then bringing it back here into these years, that's exactly what we would be doing right here. here, we'd be trying to identify these items out here in the highest rates and bring them back here and get them taxed at these lower rates to the extent that we can. So that summarizes the overall high-level Roth conversion strategy that we're going to be using in the personal tax planning template for the rest of 2025, getting ready to complete those 2025 conversions. And the last thing we're going to do today is just talk about one possible provision that potentially could be included in the upcoming law changes, and just think about this provision from the perspective of Roth IRA conversions. And the provision in question is the $4,000 senior deduction that would apply to folks who are 65 years old or older. Now, just to be completely clear, as of the making of this video, this provision has not been signed into law. In fact, none of the provisions have been signed into law yet. So this could certainly be changed or eliminated or whatever before the finalized laws are actually passed. But let's just talk for a minute as if this was actually the new law, and that folks over 65, subject to certain phase-out ranges based on income, could get an additional deduction of $4,000 per person. Now, right here are the basics of what the provision could be if it was ultimately passed into law. It would be applicable to 2025 through 2028. It would be up to a $4,000 additional deduction, basically like an extra standard deduction, but not replacing the extra standard deduction that is already applicable to folks 65 and older. Apparently, it's going to be an additional $4,000 deduction on top of that. And I want to talk, just generally speaking, how we could think about something like that in the context of Roth IRA conversions. And the way we might consider it is that it's basically up to an $8,000 free Roth IRA conversion for 4 years. I would argue that if you are considering doing Roth IRA conversions in 2025 through 2028 anyway, then this up to $8,000 has the potential to offer you even more Roth conversion opportunity effectively for the same cost. In other words, the same cost as what it would have been prior to this law, but you end up with more conversion for the same cost. And so from that planning perspective, you could look at that as a potential up to 8,000 times 4 years is a $32,000 free Roth IRA conversion. As I said, as things are currently written, it is my understanding that seniors would be eligible for this $4,000 bump even if they itemize. And by the way, this is another item we will be analyzing in more detail to find all of the tax savings possible for you in 2025 and beyond, because if the current proposals are signed into law, many more people, including many people watching this video, will probably be itemizing because the SALT cap, that is the deduction for state and local taxes, is currently proposed to be raised from $10,000 up to $40,000. This is huge right here. This alone will cause many more people to start itemizing deductions again. And when I say again, I mean folks who itemized prior to the original Tax Cuts and Jobs Act in 2017, folks who itemized back then but stopped itemizing because of this $10,000 SALT cap, which by the way was quite a large group of people. Then we may have even more opportunity here for Roth conversions. For example, thinking along similar lines as this thought process right up here, if you would have, for example, in 2025 been limited to the $30,000 standard deduction, but after the law change, which is supposed to be retroactive to the beginning of 2025, meaning it will apply to this year, you can suddenly itemize, let's just say to the tune of like $35,000, so you get an extra $5,000 of deduction there. We can almost consider that extra $5,000 as like another free quote-unquote Roth IRA conversion. And when I say free, I mean compared to what you would have gotten before the law change, you are now getting $5,000 more Roth conversion, so to speak, for the same ultimate tax cost. So anyway, I don't want to get too deep into these provisions now since they are currently not the law, but as soon as they become the law, we are going to start digging into those and seeing how and to what extent we can incorporate those into our Roth conversion planning. And so to be continued on these various law changes that I highly expect will be coming our way pretty soon. I already mentioned the phase out range on the additional $4,000 senior deduction, but just FYI, currently it's proposed to be fully phased out at about $350,000 of income, $350,000 of MAGI, which is basically just like AGI plus tax exempt interest generally. But as always, as I always say, each person needs to lay out your numbers in the personal tax planning template and figure out where the tax savings opportunities can be found based on your specific facts and circumstances. There is no one size fits all when it comes to tax planning, and that's why we have to sit down and figure it out. By the way, I have just uploaded an all-new 8-part 2025 video update series to the members area to get everybody's mind refreshed on the inner workings of the personal tax planning template. We're going to cover getting your 2024 base year tax planning information entered into the template and in agreement with your 2024 as filed tax return. We're going to go over technical updates to our inherited IRA and standard deduction calculations. We're going to do a complete IRMAA review to make sure you're considering all relevant impacts of your Roth IRA conversion decision. We're going to do a complete refresher walkthrough of the Roth IRA tax strategy tab to make sure you understand the traditional IRA fair market value projection process, how to calculate your RMDs, and how to find room in those lower brackets in post-retirement pre-RMD years. So if you are already a member of the Personal Tax Planning Template program, you can simply log in at your convenience and check that new series out. And if you're not already a member, the Personal Tax Planning Template that you've seen me demonstrate throughout this entire Roth IRA conversion video series is available for purchase at the link in the description below this video. Your purchase helps out the channel and provides you with a tax planning and analysis tool set that you can use throughout your life to help minimize your taxes and maximize the after-tax cash flow that stays out of the hands of the government and in your family's pocketbook. So it's a win-win for everybody. As I said, the purchase link to that program is available in the video description directly below this video on YouTube. So that's going to be it for part number 9 of this Roth IRA conversion video series. I hope you enjoyed today's video. Thanks for watching, and I will see you in part 10.